I've learned a lot from the London Metal Exchange and the CME and ICE and the Hong Kong Exchange Group and all of the great Chinese exchanges. I've learned a lot over time, and I think they're going to learn from us as well. So I think it's important to just keep moving the world forward with information, trying new markets, and ultimately solving customer problems. I think that's what it's all about.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abaxx Exchange, where trading in centrally cleared, physically deliverable LNG and carbon futures contracts is now underway. Ready for smarter markets?
Welcome back to part 2 of our Smarter Markets Holiday Special 2024. I'm Dave Greely, Chief Economist at Abaxx Technologies. We're continuing our conversation with Josh Crumb, founder and CEO of Abaxx Technologies, and our colleagues, Sacha Lifschitz, David Gornall, and Steve Lowe. This year, we're talking metals markets, battery metals and gold. We'll continue our conversation on our Smarter Markets vision for the metals markets and how better market infrastructure and financial technology can be brought to bear to make these markets fit for purpose for today's commercial needs and tomorrow's. We'll pick up where we left off last week with Josh.
With gold, what a lot of people miss, we get a lot of information around the financial use case of gold, but I think we forget the fundamentals of why gold has that use case in finance to begin with, right? This wasn't, we just had this collective belief in gold as money. With every commodity, it starts with really 4 key first principles to the commodity. It's the marginal cost of production, it's the marginal utility and its consumption, it's the cost of storage or the carry of the metal, and then the cost to transport or where the supply demand is. Those are the 4 fundamentals of a commodity, sort of everywhere and always. And if we look at something like the gold market, it didn't become money because people liked it in jewelry. It didn't become money just because it was shiny and all this, but it had those commodity properties that it's got a very high marginal cost of production, pretty much the highest of any commodity because of its relative scarcity. So it takes a lot of energy to extract. So it's always going to have a first principle marginal cost based on a very, very high energy cost. Until we solve free energy, you're just never going to change that. That cost structure is there. But the marginal utility is not just keeping gold in a vault in the financial system. The marginal utility is jewelry, and not just because it's shiny. I also started a technology jewelry company in the past, co-founded, and you put a 24 karat pure gold bracelet next to anything in 18 or 14 carats, it's a dramatically different product. So you can't just fake gold. Gold in jewelry is one of a kind, and there's a couple properties beyond its shine. It's also very easy to scrap and recycle, which means there's a trade-in cost that's very low. And so it really is a perfect metal. And then also, if you think about why are people gifting, and using jewelry, there's a lot of things, right? There's identity signaling and wealth aspiration. There's a gift of, remembering a loved one or a memory. And that plays into gold's property of never oxidizing or changing or corroding, right? So ultimately, why am I going on about jewelry? There's always a next billion people of aspirational wealth that their first step in wealth is generally jewelry. That's not confined to any one culture or one continent. So it becomes very good warehouse material as money because there's always a marginal utility and a marginal demand of a next billion people demanding the commodity. Obviously, there's going to be periods where financial flows overwhelm the jewelry market, always, right? Whether it's the supply or the demand side overwhelms it. We have periods of high financial demand and jewelry gets crowded out. You build up a lot more financial inventory. And there may be periods where real interest rates go a certain way and you get a lot of destocking of financial, like in the late 90s. So of course, the stocking and destocking of financial inventory can change the market, but the fundamental long-term market and the store of value comes from the marginal cost of production being extremely high and always having a marginal demand and utility in the jewelry market, and then a very low cost of storage, which makes it good money because you don't have a lot of decay or a lot of carry on the inventory. So anyways, I went through that whole thing because I think there's a lot of bad information in the gold market. And you always have to come back to those first principles to understand what does the market actually need.
I'm beginning to understand now, Steve, how you and Josh may have gotten talking. But let's bring you into the conversation. I'm curious how you and Josh got to know each other and work together.
As always, thanks for having me in. You can tell that Josh is pretty passionate about gold, which is great. I've heard of Josh, for he has a reputation in Toronto in the gold market, and I started working in Toronto. I count as the third of a century ago, so I started in 1990. But I ultimately met Josh and really got to know him a couple of years, maybe 3-4 years ago, when he was just starting Abaxx and looking at gold, and we had a mutual connection who Josh was sort of trying to get some information out of, and the mutual connection said, really, if you want to talk London metal, gold, then Steve's probably the guy to talk to. And then I was introduced and have been on the Abaxx train ever since.
I would say it's probably the same amount of people that truly understand the Satoshi white paper, truly understand how the gold market works behind the scenes. And you were co-head of the global base and precious metals business at Scotia Makata. I was hoping you might be able to walk us through behind the scenes a bit. How does the institutional gold trade work? And how does it relate to what people are probably more familiar with, the retail gold market?
It's not an easy question to answer, but I'll start by saying that when we traded in 1990 on the gold desk, when we traded in 2015 on the gold desk, they're basically the same thing. The only thing that stopped was we used to be on the desk of call outs in terms of our head spot trader would want to unload some risks. So we'd all jump on the phone and call around. And now that's done through electronic chat mechanisms. But that's pretty well all that's changed in pretty well 35 years, to be honest. But yeah, I mean, working for a big institutional player and we one of the biggest around, there is a very liquid wholesale market in London. So London is the big OTC market. And if you want to lend and borrow in this market, it's quite robust. It's quite liquid. And then we'd often hedge our risk exposure, our spot exposure through COMEX futures. And that is traditionally the way the business is still done. And I think what's interesting to note and relates to your second part of the question is the institutional market is a very small market. It gets the correct rap of being a bit of a club. They call it sort of the London Boys Club in terms of it's very inaccessible to many people, mostly because gold's expensive. It requires a lot of capital. There is no central clearing platform in London. So it's all bilateral credit lines between financial institutions, which means that there's really only a handful, and it is a handful, of sort of big institutional players that play in the market. And I bring that up because the institutional market and the retail market are completely different animals in terms of your average small jeweler, small retail client has no access whatsoever to the institutional market and which is the gripe today, paying a middleman who's paying a middleman who's paying a middleman to get access to that market. And that makes many of them unhappy.
And you can see that state of unhappiness. It's curious, right? Because I listened back to what Josh said. He was talking about how gold jewelry is typically kind of the first step that people make onto the wealth accumulation ladder, particularly in a developing country. And at the same time, the financial gold market, as you said, tends to be known as the London Boys Club. So you have a very democratized market on one end and a very closed market on the other. What kind of tensions does that create?
Well, it creates a lot of tension, mostly because you're quite right. If you've ever, and I've had the privilege of traveling the world, and if you go to an Indian wedding or a wedding, the bride is adorned with jewelry, gold jewelry. That is the way wealth is transferred. It's the way wealth endowed and it's given in principle dowries. And, it's an amazing concept to see as a Westerner and who looks at gold jewelry as one, huge margins in terms of if you went down and bought a ring somewhere. And also the West tends to be not so much into physical, while the East is hugely into physical. So that transfer of wealth and dowries includes coins and bars and all that type of thing. And so the real tension is just that in terms of if you want to go buy gold jewelry, I'd recommend anyone go to Dubai, right? Go to Dubai because they'll actually take a piece of jewelry, they'll put it on a scale, they'll weigh it, they'll look at the international price, and they'll charge you 2% for that. Go to a Western store, you walk in, you pay 100% margin or whatever it is. And that sort of access for those jewelers and people to get sort of unbelievably good pricing is non-existent. And that's mostly where they'll get upset. One is pricing, And two is the business is made up of financing in terms of how do I get financing? And again, that is a small group of banks. And we'll talk about it a bit later. And why that is also there's been no technological advances to allow collateral to move easily and quickly and to collateralize jewelry inventory. There's a whole bunch of market infrastructures issues which cause strain in the system.
And it's interesting because when I hear you talk about what's happening in the physical gold market, it doesn't sound dissimilar to what we're seeing in many other commodity markets, right? Where the physical market seems to be evolving and migrating away to the way the traditional futures markets work. We saw that in nickel with, more and more of the demand being on the nickel sulfate side, the battery metal side, and the contracts still being for refined nickel, and that creating, the tensions that led to a lot of the chaos on the LME. And I'm curious, if you look at the physical gold market, as you said, you didn't say, hey, if you want to buy gold on the street, go to London. You didn't say go to New York. You said go to Dubai. So we're seeing the physical market increasingly moving to the Middle East and Asia, increasingly a kilobar market, as opposed to the units that it's sold in more of the Western countries. And I'm curious, how big is an impact is this divergence between the physical market and the financial markets in gold having, and what strains is it creating in how these are being traded?
I could spend about an hour answering that question. So you highlighted a point there is the fact that the physical demand has always been in the East, right? So as you move further east, the nature of the business becomes more physical. Western's financial, and it's always been that way, right? But what you've actually seen is, as you were mentioned earlier, a growth in wealth in terms of the East, much more demand for that physical. And then the development, if you ask me what the biggest change has been over 30 years, it's been the development of those Eastern markets, right? So it used to be banks like ours, we had an office in London, office in New York, and an office in Hong Kong. And Hong Kong was the center of the Asian market. And China came along and said, well, we're going to take a bit of this market. And then suddenly you see a market in India, like a proper exchange opening in Dubai, one in Malaysia. And so the East is now sort of come into its own in terms of the demand is here, physical demand is here, and yet we don't have a sort of consolidated market, which is very liquid in this time zone. And so that's a bit of a problem in terms of that evolution of the importance of the Eastern consumer and the Eastern market in general has been what's been unbelievably sort of visible over the last 20 years. And that market is more physical. So the market has become more physical because the main centers of demand now, or big centers of demand, are always physical. India has always been that way, but now I'd say Southeast Asia, Asia's really said, you know what, we're big enough markets now. You need to pay attention to us. It's caused, and we'll talk about it later when we bring David in case, there's just dislocation risk in markets and risk management, how you manage risk across a financial institution in terms of, I got business in New York, I got business in London, I got business in Asia and Vietnam and Malaysia. How do I price risk all that effectively and capitally efficiently, which is a challenge for institutions.
Let's bring David into the conversation. David, it's great to have you back on Smarter Markets. It's kind of interesting, right? The last time you were here, we talked about the strains that COVID-19 shutdowns had put on the gold markets, particularly making it difficult to ship gold and close the arb between the COMEX futures market in New York and the spot physical market in London. Now we're seeing and hearing the arb widening out again due to the threat of tariffs under incoming President Donald Trump. So it's a bit of a Groundhog Day situation, but maybe you could just bring us up to speed on what's going on there.
You'd call it groundhog. I'd say I'm getting a bit typecast here, aren't I? Who's bring me into dislocation chat? Was it when markets break? In November, there was a lot of talk about the incoming US administration using the word tariffs rather freely and easily and quite naturally. That got extended to gold and silver and what if? And I thought about this and thought, as a monetary metal with the US in isolation, who's going to pay a 10% premium for gold in the US when they can pick it up somewhere else? And so it wasn't really something I thought was a real threat. But nonetheless, people could see that there were some people that would have to pay it because with all the swap dealer information that you can see, the publicly available information that the exchange puts out, that there were probably 300,000 contracts outstanding. And if you couldn't deliver it, then you'd have to buy it back. So there was a candidate that may have to pay the premium. And I think by the first week of December, we touched $65. Deja vu moment there, with almost touching the $70 that we saw in COVID. And some of the background to that was similar, that still costs in the order of 60 cents to ship gold from Asia or Europe to the United States, but you've got to find the units. And at this time of year, you'll find a lot of the producers are slowing it down rather than speeding it up. And logistically, with the airlines, it's a problem. So this is how we ended up at $65. I'd say silver was even worse. It touched a dollar an ounce, and it's still, I think, 44 cents today. And that's because you can't put it on a plane. You have to ship it. That's going to take you to the thick end of 20 to 30 days to get it there. So that's what talk of tariffs do. But I thought the interesting thing that I'd noticed in some of the presentations I've been listening to about Basel III was that the 3.1, as people like to call it, that includes the fundamental review of the trading book, says that banks will have to conduct a P&L attribution test. And the synopsis of that is vis-a-vis this situation is that the more dislocation risk that you see when you're looking at your back testing, we've already had one instance in 2020, and now we've got the second here in 2024, the likelihood of risk managers reducing the risk of shorting futures is quite high. So that I'd say that the effect of that is that the liquidity could dry up when these markets surge again. Because unless you've got the units, the physical units to deliver, I sound like the same podcast we did a couple of years ago. But unless you've got that all lined up and you've got all your ducks in a row, you're not getting out of that trade. I mean, just to put it in context, that type of short is costing you in negative variation margin $30 million per dollar move, and gets to 65. Someone's having to fund the end of $2 billion. And we have seen people bite the bullet on this, saying that can't just keep borrowing money to finance this until February. So it was the same effect as last time, but a different cause.
And with the different causes, and I'd love to hear other people weigh in on this as well, because I think it touches battery metals markets, as Sacha was discussing. Steve, obviously you can talk to gold, and Josh as well. I feel like increasingly we're seeing regional differences driven not just by location and logistics of what you can ship, but by regulation. And that because different commodities are being regulated differently in different places, that's becoming a big driver of the risk. And I'm curious, when you look at that, David, how big a risk do you see there of these regulations going forward, things like the Basel regulations you referred to? And how important is it increasingly to have the gold spot and futures market in the same place, in the same regulatory jurisdiction, I guess, in this case?
There is a rule that is actually going to come to focus on that. So again, in the FRTB rule, unless you've got the location of the long and the short in the same legal structure, you're going to be penalized with additional regulatory capital to add to the trade. So I think it is going to focus the mind on saying, well, hang on a minute, if we've got a physical long here and the short is in the same place, we don't have to worry. If it's in another legal jurisdiction with a different legal construct, then we've just got to provide more regulatory capital to that. So, there will be a market efficiency going on there. I mean, the other one is the sort of level playing field where Basel likes to measure how these rules are implemented in the major jurisdictions. And very quickly, when we saw FRTB kick down the road for a year, it wasn't too long before it's implemented in Jan 26 via the EU. The UK followed suit, and so did the US. So everybody is trying to sort of stay in lockstep, so nobody wants to be behind when it comes to implementing this rule for their own banks. I think it's a valid point. It's not a risk. I think it's a real thing that's happening.
And Steve, is this the type of thing that you used to have to deal with, or is this kind of a new evolution for the gold market?
It is definitely what we had to deal with. And I can tell you that financial institutions are driven and business is driven by these type of decisions. To your point and David's point, I mean, most banks are long London, short New York. That's just almost every bank is. And when COVID happened and that blew out, I mean, David is so right in terms of what they'll do is they'll back test that ARB. We would know to the day if there was a bleep in a back test when that came off, right? We would know exactly the day. It's okay, tomorrow we're going to have less risk on our book. only because a backdated thing, big move in the market, is about to roll off. And so therefore our risk will be reduced. We can do more business tomorrow because our risk managers think our book has less risk in it. And so we were so driven by those things. And different banks and different jurisdictions implement at different times in terms of, I remember dealing with high liquid assets and what is that ratio we had to deal with. And the amount of the bank came down on us day after day to get in line. It's huge. It will absolutely drive business. This is what affects the banks, and the banks are the major players in the gold market, like it or not, right? But non-banks, they'll be fine, and they'll be more competitive. No doubt about it.
Let me bring you back in, Sacha. You've been listening patiently over there. I'm curious, is this something that's been something you've seen in the battery metals markets as well? And how does that affect things?
Thanks, Dave. Yeah, wonderful. I'm very happy to pick up on this. Arbitrage obviously has really been on the forefront of our minds when we started talking about how we could develop these nickel or battery materials markets. And you see currently huge differences between prices, just as an example, for nickel sulfate between the domestic price in China and the prices in Europe and the United States. And that's exactly what we're trying to help the industry to mature here, where we bring in these regional contracts, allowing these markets to converge and bringing a better price point, which maybe is just really reflecting a normal arbitrage price difference for, freight costs and financing costs, but nothing else than that. And you had gaps of $1,000 between nickel sulfate price in China and nickel sulfate price in Europe, which is just from a pure physical economics point of view, doesn't make any sense. So that's one thing, creating these regional contracts. Another aspect, for instance, is, you have, for instance, for lithium, you have physically deliverable contracts on the GFX, Guangzhou Futures Exchange in China, where you don't have any physically deliverable contract outside of China, or let alone US dollar denominated. That creates another huge liquidity pool for the financial industry, but also creates opportunities, obviously, for consumers and producers alike, so for new projects, where you again try to bring these differences to the table and then let the market play out the justifiable differences in prices. And then I think another aspect, which you've also already touched on, jurisdictional issues, ESG requirements, and the whole trade wars, or let's say the regional requirements, when it comes to IRA compliance, or what European battery regulation is going to bring on in the next 2 years. That remains to be seen, and that's really a moving target. And we also have to take this into consideration, the way we list our brands, for instance, or the way we look at what we do in certain regions, what do we do in the United States. There's a huge demand there for the whole battery industry of having IRA-compliant products, both on the nickel and lithium side. And that's something we are addressing. That's something where we even get approached to, with our platform and say, listen, can you come up with solutions, how you can address these things, helping basically the West to finally bring up this supply chain. We all know, the state of the European, for instance, battery markets is a disaster. You had like 11 out of 16 projects of battery production either bankrupt or in liquidation, or, in major financial distress. At the same time, then you have Asian and predominantly obviously Chinese and Japanese, Korean producers of batteries moving into Europe, building their plants and helping the automotive industry there, which is another threat, for instance, to the European, or let's say to the Western car industry. So by bringing on these contracts and, helping to really bring better price points and more transparency into these markets, the challenges are there, but I think we're addressing the right points here.
And David, I've registered your objection to me only asking you to explain why the New York-London ARB has blown out. So given that, I'll also note that you've been a strong advocate for the use of gold as a high-quality liquid asset in the modern financial landscape. Could you explain, what does that mean, high-quality liquid asset, and why is it important to the modern financial landscape?
Okay, I'll try and do the short version of this one rather than the normal 18-pager. So post GFC 2008, part of Basel III, two ratios were developed, the liquidity coverage ratio and the net stable funding ratio. And they relied on coming up with a classification of what a high quality liquid asset was so they could be held as a liquidity reserve. And the level ones, the assets that people use the most in banking are central bank money, cash at central banks, and government bonds. And the problem for the market, I won't say the gold market, for the financial market generally, is that at the time of this assessment, there was no data available to measure the size of the market, to measure the liquidity of the market and the depth of the market, which is now not the case. So since 2018, LBMA members have to report their trades on a daily basis. So a couple of years ago, the World Gold Council and the LBMA joined forces to try and put a bit of a spotlight on this dilemma, especially after what happened with Silicon Valley and with Credit Suisse, where high quality liquid assets were very much in vogue. And the drawdown assumptions made on these high quality liquid assets turned out to be wrong. They assumed that deposits would be sticky and they would remain with banks for a lot longer than the 48 hours that SVB lost 80% of its deposits. So we were looking at how that could be improved because it's effectively a duopoly of those two asset classes, whether gold could fit into it. And the data and the analytical studies that we've done using an academic does say that gold is of the same quality as some government bonds and therefore should be an extremely high quality liquid asset. And it would take the pressure off of government bonds because they're used for absolutely everything. They're used as a monetary policy tool first and foremost, but they're used as a liquidity tool in this instance. And for the most part, people in the market use them as collateral instruments. There's a lot of pull, there's a lot of demand where we would probably say that the market would be better off with a third asset class, and gold would be that asset class.
And bringing it back to you, Josh, how does gold and its use as collateral fit into your thinking and vision for creating full digital title and moving to shorter settlement times for commodities?
Yeah, well, I think that's a great setup. And I totally agree. Because again, go back to the first principles of why gold is vaulted in the first place, why it has a low cost of carry, why it does become good collateral. And I think it checks all those boxes. And I think increasingly, I mean, we'll see where inflation heads in various economies over the next couple quarters, next couple years. But we're obviously in a sort of a debt situation globally where we do have these issues of potentially going into deeply negative real interest rates to maintain government spending, essentially. And so there are obviously a lot of countries, companies thinking about what kind of reserves they want to hold for highly liquid collateral and reserves. I think one of the things that has obviously hindered gold is this market structure issue, right? Where futures in one jurisdiction spot over the counter, not centrally cleared in another. Of course, you've got long settlement times. The front end of the trade, gets faster and faster with electronic systems and electronic trading systems. But that doesn't mean you're physically settling the title transfer of the gold in any faster way, right? Which then creates other liquidity haircuts or settlement haircuts or collateral haircuts because of the slow physical settlement. So if you get to a point where fundamentally the asset itself is highly liquid and good collateral, now you're talking about solving some of the settlement complexities so that it's used in a way that bank ledgers can be moved around so quickly. And I think that that's where streamlining the pre-trade and the post-trade together so that you can get to this sort of T+0 settlement and a digital title on the warehouse gold, this just optimizes the whole system. That was a big part of Abaxx's technology investments from day one. And it doesn't just go for gold, by the way. I think there's ways to create collateral instruments out of a number of commodities or even first right payables on a commodity so that you get away from some of the cost of carry and warehousing costs. There's a lot of innovation still to be had to use, moving beyond just, sovereign debt instruments as liquid collateral for trade. In many ways, China, it was for sort of different reasons, right? It was a lot more to do with, raising US dollar liquidity, particularly in the East. Commodities have been used as dollar funding collateral for a long, long time. But it's how do you do that more efficiently with less risk? How do you improve on things like KYC and not double pledging the collateral? This is all technology driven. So again, this just comes back to, solving the needs of the market, both in market structure and technology.
And I want to thank you all for being here. It's been a great conversation. We could talk about lots of these things for hours, so I'll have you back for individual conversations. But before we go, because it is a season of hope for the future, I kind of wanted to take advantage of all this collective experience in these markets and just go around the horn and ask each of you the same question, which is, what is your vision for the markets that you've been involved in for your career for the future? What would you pick as kind of, hey, if we could fix these problems or we could make the market work more this way, that would have been great. Because I think anybody who's done a job for years or decades, you kind of sit there and there's a lot of pebbles in your shoe and you say, oh, I would have enjoyed this much more if we could have done this differently. If you look out at the battery metals markets, the base metals markets, how would you like them to be in the future? Maybe we'll start with you, David.
Well, I'd say it's about access. You hear a lot of people saying that we have to go through lots of different intermediaries to get to where we want to get to, and we're part of the market too. So I think that's the main thing that I'd like to see is the access improved, which is going to bring liquidity into a more central pot. It's going to improve it for everyone, I think. I don't think there's any too many losers in that. And also to streamline the processes using technology. So the efficiencies of capital are driving most businesses at the moment. So if we can find a way to eradicate all of those bumps along the way, then I think that the markets will move a lot more efficiently than they do today.
How about you, Steve?
Mine's not that dissimilar from David. I mean, the gold market as a market infrastructure it's just old and dated. If I could snap my fingers and have gold on an infamous digital rail where, not only does gold move digitally and effectively, so does all the paperwork and KYC, and basically having a network or an existing ecosystem, which is all digital, where things move safely and transparently. The big knock against gold is it's opaque. It's, as David said, access, but it's also transparency. And people they don't know what's going on. And having everything properly visual and digital, I think would be awesome. And the market, it would grow the market vastly. The World Gold Council does a study every 3 or 4 years, and it talks to all the investors out there and says, why don't you invest in gold if you don't? And they come up with the same thing. They don't trust it, and it's too opaque. And those are easily solvable problems, easily. But we just haven't got there.
And how about you, Sacha?
So look, I mean, it's obviously a suite of products, and I think it has, there's different visions for different products. I think on the lithium side, for me, it's very exciting because I think, what we're creating here is really helping the whole industry and helping, this specific product evolve and mature. And we're really at the very beginning, making this physically deliverable, making this more transparent market, allowing more players to get involved, also helping projects because we need a lot more projects that are going to be able to make money to get off the ground. So I think it's very exciting, to really be part of this huge journey, which in my view has only just started. And then generally nickel and maybe even other products which we're going to create, which already have existing markets. I think, to add transparency will help arbitrage opportunities as a keyword. And then we also, I think, going to standardize, make trade flows more easier. I think that's certainly something which we need, having better benchmarks for new products. So again, it's just, these things are evolving, and I think we are at the forefront of helping these evolvement.
Josh, you've shared a lot of your vision throughout the call, but maybe just to finish us out today and for the year, you could tie it all up in a bow for us.
Look, I'll reflect some of the things that were already said by just taking myself back to where the world was in the early 2000s when I first tried to buy gold, for instance, right? And having to go through, you're trying to find a local, gold coin dealer at some high over spot. There weren't these electronic accounts. There weren't ability to buy and sort of the technology democratizing access. So I think that's number one is just, again, like this is the path of markets. And the second, which is very related, is information, right? And I think that's another big part of smarter markets. I wish I had the information, both the podcasts and the experts, like Sacha and Steve and Dave talking about these things before we were doing a hedging program to get our face ripped off, right? The information really wasn't there in that way. And now we're going to a world where not only is it, we get these experts on podcasts like SmarterMarkets and others, but now we can rip them through a large language model and produce a white paper in seconds. That was never available. And I think that's just an incredible path of optimization in the world, is that ability to take decades of history and understand the complexities and then very quickly get it to market and synthesize it in ways that people can digest. So I'm super excited about market infrastructure, adding more transparency, adding more data. But I think just in the broader Abaxx building market infrastructure and financial markets, what I think is so interesting is just the pleasure and the honor to be able to do it is actually taking time and building it. In mining, we have a couple sayings that I think are important. One is plan your mine and mine your plan. When you know the long-term nature of what you're doing and it's been well planned and well thought out and well, de-risked through, don't always chase the latest trend, but stick to your mine plan. All of these things that we're discussing, this was part of the vision back in 2018, 2019, and the world just keeps validating, the things that Abaxx are doing over and over. We planned our mine and we're mining our plan. And I think we're getting to the next very important juncture of that next year. And I think the second key phrase that I like in mining is high grade covers a lot of sins. Look, this stuff isn't easy. We're going to take some bad turns. But remember, an exchange and a clearinghouse is pretty much the most profitable business in finance when you get it right. Commodities within that is the most profitable business within the most profitable business in finance. We do have a high grade margin business model. Yes, it takes time to build these markets, but we're going to do it right and we're going to stick with it no matter how long it takes. And I think that's important because very similar to physical infrastructure, right now, I think the average, time to bring on a new mine is something like 16 years. Now, we're going to be faster and we are faster than 16 years, but this stuff is complex and it does take time. So, imagine if Abaxx didn't start this work 4 or 5 years ago. And look, and we've got some very competitive, formidable companies, great market infrastructure companies. I've learned a lot from the London Metal Exchange and the CME and ICE and the Hong Kong Exchange Group and all of the great Chinese exchanges. I've learned a lot over time, and I think they're going to learn from us as well. And so I think it's important to just keep moving the world forward with information, trying new markets, and ultimately solving customer problems. I think that's what it's all about.
Thanks again to Josh Crumb, founder and CEO of Abaxx Technologies, and our colleagues, Sacha Lifschitz, David Gornall, and Steve Lowe. We hope you enjoyed our 2-part holiday special 2024. From all of us at Smarter Markets, we wish you a happy new year and all the best to your friends and family. We'll be back next week to kick off a new year on Smarter Markets. We hope you'll join us.
This episode was brought to you in part by Abaxx Exchange, where trading in centrally cleared, physically deliverable LNG and carbon futures contracts is now underway. Ready for smarter markets? Contact us at onboarding@abaxx.exchange. That concludes this week's episode of Smarter Markets by Abaxx. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abaxx Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.